Hello and welcome to Team Alpha's data analysis presentation. We have decided to do our analysis on stocks. Team Alpha consists of myself, Chris Oliveri, and Tean Ahmed. Okay, in our analysis, we're going to go through a whole bunch of slides here today. We're going to talk about the investment strategies, or essentially what the problem is, a little bit of background research, talk about why we uh, the different methods that we're looking to do and how we're going to set it up, how we get the data, what it looks like. We're going to talk about the analysis and some conclusions. So here we go. Okay, so the company that we work for, essentially what we want to do is we want to improve our investment strategies. You're always looking to do that for the company, when you're investing and trying to make money. So that's a good thing. Our current strategies, we're not using any sort of, analytical approaches, not using any sort of past data performance, so we're looking to do it. Essentially, we're looking to have better investment strategies using data analytics. That's the goal. The question is, can historical stock prices help us with investment strategies? We'll see. People have been trying to do that since, people started investing in stocks. So it's definitely something that's very difficult, but we'll take a look at our analysis and see what happens here. All right, before we do our analysis, there's definitely some things that we need. First, you need some people, some analysts that are trained in a multitude of different type of data analytics. You need somebody who knows a broad stratus of these, so they can take a look at the data that's presented and pick out the best model, the best prediction model. In addition, you need some software that can run the analysis, and you need some software that can visualize the analysis. So that's definitely a need for sure. And it's also a good idea to take a look at what other people have done before us, in order to get some ideas, because there's definitely somebody who's already tried to do what you're doing. So it's definitely a good idea to research. Okay, so what we're looking to do is on our analysis, we have a data set and we're looking to do two different types of analysis, logistic regression and time series analysis. For logistic regression, we're looking to build, a model using both naive forecasting, and for the time series analysis, we're looking to predict, using the same variables, what is the trend in that? So that's what we're looking to do. Okay, so to get our data, we went online, found some data at the University of California at Irvine, machine learning repository. We found a data set from the Dow Jones. It had about 750 records. 2 quarters worth of data, and it's kind of done every week. It came with 16 attributes. The data set was pretty nice. It came pre-scrubbed. It had a lot of the things that we wanted. So we were able to, pretty much go right into the analysis after, getting this set of data. A little scrubbing and a little work on the data, which we'll get into, but it came readily available to use. So the first thing that you should always do whenever you have a new set of data is you should explore it. Just throw it on some graphs, compare some variables to other variables, see what the trending looks like if it's time based, and take it from there. And that's where you can, a lot of times determine what type of analysis, what type of model you wanna go with. So that was definitely the first step in our model right here. All right. Yeah, we explored the data in Excel and in Tableau. So let's take a look at what it looks like. Here's a list of stock prices. There's 30 different, like I said, 30 different companies. We have, as you can see, IBM is like the most expensive, and then you have BAC at the bottom, and pretty much all the ones are most companies that you've heard of: Cisco, Cat, Caterpillar, American Airlines. So a lot of GE, a lot of companies that you've heard of. All right. This graph shows total volume traded. So it's kind of like the sum of the total volume over the past several months. So as you can see, the stock price isn't really related to that. Actually, the cheapest one was the most heavily traded. So that's something you can definitely take a look at, and something that should be looked at when you're developing investment strategies. All right, here's another graph with more volume traded, and this one is done by month rather than by company, so you can kind of take a look and see what months the most people are trading back and forth in. And here's some data exploration we did in R. As you can tell, if you've played with R quite a bit, this compares a lot of different variables and kind of shows what the plots of what the relationships are between the two. Okay, so whenever we got our data set, we needed to transform it a little bit in order to get it in the format we needed to do the two different types of analysis. For logistic regression, we needed to create a lag variable where we made a category, that has, if the stock price went up, we labeled it up. If it went down, we labeled it down. So that gave us the categorical variable, which you definitely use for logistic regression for. To do time series analysis, we did some. It kind of came pretty steady, pretty ready to go for time series analysis. We just needed to change some variables around. Instead of being on the top row, we needed to put it down into a column and have it changed out that way. So a little old-fashioned cutting and pasting in Excel. I'm sure there's, if there's just something we wanted to do over and over again, it's something you could set up doing a macro or some VBA or something like that. Okay, so definitely some items you want to look at whenever you're doing modeling. Obviously, you want to avoid overfitting. Overfitting has been avoided in the logistic regression by carefully partitioning the data. That's the main way we did that. Um, with the time series analysis, there uh, wasn't a whole lot of manipulation that needed done in order to prevent overfitting. Stocks, aren't inherently seasonal, so it's really hard to fit the model exactly. It's really hard to overfit the model whenever you're dealing with stocks because they do vary quite a bit, and it's hard to really, you know, figure it out exactly what's going to happen in the future. Resampling techniques were not required for this data set. The main way the main reason why we didn't is we did the analysis on just several of the variables. There were over 30, so if we wanted to look to compare different models, um, we could have just done it with the rest of the stocks, so we didn't have to worry about that. Remedies for class imbalance. We did use some classes, such as the stock variables up and down in the lag 1 category. So class imbalance is not really applicable for us in this model here. All right, so reason why we use time series analysis. Um, the type that we used is we used exponential smoothing time series analysis without seasonality. The reason why is because stock data, like I mentioned before, really is not inherently seasonal. Um, we really wanted to look to get a smooth forecast, a lot smoother than what the past historical values were. So that was the main reason for the exponential smoothing without seasonality. The main reason for the logistic regression is because we had categorical variables, because we were trying to predict if stocks are going to go up or down. Logistic regression is one of the best different types of model for doing that. In addition, on this slide, we kind of described how we went about doing the logistic regression, separating out the data and everything like that. All right, so in the time series, whenever we did the time series, we used two different programs. We used Excel and Tean used Tableau. It's the first time either of us have used Tableau, and it actually made some, very similar results to Excel. I mean, it's the same math that's going into both of them, the same statistics, but it gives you different visuals, and it kind of gives you a different view. So it was kind of nice to see the two different programs. Here's a time series analysis that we did on the IBM stock. As you can see, we fitted a forecasting line to it. The period on the other side of the yellow line in Excel, and in the pink area, that's our forecasted area. So you can see the dotted trend line that we were able to place in it. Here are some of the errors from the error analysis from the IBM time series analysis. As you can see, the MAPE is at 1.7, so that's percent, so that's not too bad. That's something that's definitely shows, the trend line is pretty close. All right, and here's another analysis of a different company for CAT. Um, this guy's MAPE is a little bit higher, so it definitely shows a little bit more variance than the IBM was, but still not too bad, considering the variability. And here's with AA. Again, it had the same MAPE as CAT did, so it's pretty close as far as the models. All right. When forecasting 4 weeks out, as you can see, the MAPE definitely increases, so that's to be expected. Okay, so now we get into the logistic regression results. First thing when you do with logistic regression is you definitely want to see a summary of the data. So this shows a summary, min, max, averages, all that sort of stuff. Okay, here are some results that show that there's no really correlation between volume and stock price movement. Like I said before, that's definitely something you want to look at. In fact, it's a negative relationship. However, there is a strong correlation between opening and closing price, but that's to be expected because, stock prices, as you know, don't change that much after trading out. Okay, of the logistic regression, the naive approach gave an accuracy of 69.46%. So we have, so essentially what this means is, based off of the past data for the next week out, we were right 69.46% of the time that it was going to go up using the naive approach, up or down. We predicted it right. So that's actually pretty good. Um, All right, when we used the logistic regression with data partitioning, it actually went down a little bit, 64.1%. So the naive model was actually a little bit better. So it's definitely something to look at. So for our conclusion, for time series analysis, and for logistic regression, the naive approach was a better option when we had the trend line with upper and lower confidence levels. This will give us a really quick view, a quick view and a tool for the investors to take a look at to help them make some decisions. For the logistic regression, like we discussed, the naive rule was better than with the data partitioning. 69.46 was actually was higher than the 64%. And overall, if that's pretty high amount. So if you took a bet that it was going to go up or go down, you'd be right 69.46% of the time based off of this information. So it's not too bad. Um, yeah, it doesn't say how much it's going to go down, up, or how much it's going to go down, obviously. So that's something to take into account as well. So that's basically the results that we got. Future work, if you wanted to put this with other data, obviously you would need to scrub the data and get it in the proper form to run the analysis. But besides that, the model is there and can be used. Some additional work we could do on this. We could definitely look at neural networks. That would be something that this kind of data set would go along. And then, yeah, and you could also just use the same model, but use it for all the different stocks and not just the ones we did. So overall, that's pretty much what we have. It's definitely something to look into if you're looking to invest. You have the tools that you can do it with. So take a look at it and hopefully get some good results and make some money. But thank you for your time. And any questions that anybody has, please feel free to reach out to Team Alpha. Thank you.